The first thing to do when it comes to geopolitics is to do nothing, is to watch, absorb, and try and understand what the playing field is here, what the ramifications are.
Bitcoin is currently trading at $38,700, which has gone down 10% in the past 7 days, while Ethereum is down 12% in the past 7 days, trading at $2,550 at the time of writing. The market seems to be dormant as of late, as the world is still reeling from the conflict between Ukraine and Russia. Many experts, analysts, and investors are unsure how this will continue to play out and what implications it will have across markets. Last week, when asked about the Ukraine-Russia conflict, macro analyst Raoul Pal respectfully declined to comment because he wanted to better understand what was going on before sharing his thoughts. It appears that he has a better idea of what's going on, as Raoul went on to share his thoughts in a 25-minute message to update his followers on current geopolitical events and what to do in the crypto markets. In his message, Raoul said that from his perspective, this conflict could potentially go one of three ways. Number one, seeking a common ground, which could look like an agreement to cease fire or an agreement to split up the Ukraine, possibly have a West Ukraine and an East Ukraine. Sanctions get eased off over time because everyone feels they've negotiated a settlement, which Raoul stated was probably the ideal situation in his opinion. Second scenario, the Ukrainians do not negotiate, don't surrender, and the Russians level Kyiv. This was the highest probable situation, in Raoul's opinion, very likely a bad situation because it is clear the sanctions will not go away and can cause a huge global recession. Scenario 3, which Raoul considered the worst-case scenario, is if Poland becomes a part of the war because they received an abundance of weaponry to give to Ukraine. Raoul would consider this now a war between Russia and NATO. Raoul has warned that within the next 2 to 3 weeks, we will know if we have a scenario 1 or 2. But will scenario 3 ever occur? Nonetheless, Raoul's overall message was not meant to make listeners fear for the worst, but to prepare people on what assets he believes will do really well to weather this geopolitical storm. Have a listen to Raoul's thoughts.
The other issue in the geopolitics is everybody has now learnt that the dollar is a liability and not an asset. So, i.e. dollars can get taken away from you at will. So, even though it looked like a very smart move to weaponize reserves and the financial system, what is actually happening is you are now forcing the de-dollarization of the world. Now, my view on that is that's a slower process. Obviously, Russia just got thrown out, but they've been planning for it. Let's be absolutely clear. Russia's been planning for it. They probably didn't imagine it this fast, this apocalyptical, but the Chinese will be planning it too. The central bank digital currency is part of that planning. So everybody wants to move away from the dollar. And right now, the instant thing that any central bank can do is own more gold. So I think this is a very bullish gold environment for central banks because that's what they do. It's an asset that they're comfortable with. I also find very concerning at a geopolitical level that we have frozen the assets of people that have not been tried in any sort of court. Now, it depends whether there's a confiscation going on here or freezing of assets. It depends on EU law and who's taking what. But it tells people that property ownership is not something that they perceive. If you own a property that's not in your jurisdiction, you don't own it. So I think that is, again, a shift that's going to take people's mindsets. Obviously, all of these trends are very bullish for Bitcoin particularly, but the crypto world overall over time. Now, crypto trades both as a risk asset and a store of value. The store of value element is becoming predominant right now and very clear. The risk aspect, well, it's a bloody risky world out there, so let's wait and see. China, how that plays out in all of this, we don't know, but China's been moving towards separating, and I can't yet think of all of the ramifications as we are already splitting these worlds apart. If this gets accelerated, what does that do? But the world is a net debtor in dollar terms, and the more of these debts you start writing off by forcing people out or seeing defaults, the higher the dollar goes. And the dollar is a big risk here. So if you get a liquidity squeeze, the dollar goes up. The dollar's the one thing that I'm looking at, but we also know that the Fed try and stop that because they know the dollar is the wrecking ball. They can't let the dollar go up too fast, so they start supplying the world's banks with swap lines. So every time they've done that in the past, it's eased the issue. But here you've taken out a very big economy. I mean, Russia's gigantic. Russia probably has more natural resources than the rest of the world added together. It's something of that magnitude. So the GDP may not be big, but its asset base is enormous. And without that in the world, we end up with a huge loss of trade. And we've also got these dollar liquidity issues, which I think will bite the Europeans, bite the US, and bite everybody else. So I think that's all setting up to be a bit of a mess. The Fed will come in and try and flood the market with swap lines. So the money printers start in different ways. And I know there's a lot of people who watch this go, well, that's not money printing. It's enough to start changing the denominator effect of certain assets. So be cautious of that one. I actually like bonds in this environment, because if you raise food and fuel and input costs, you're destroying demand. We've already seen demand slowing globally. We're already seeing a lot of forward-looking indicators. I've written a lot in it, and I wrote it up in the GMI that you all got. I think everybody got it. There's some of my thinking about all of that, and I've been writing about that frequently in GMI and Macro Pro as well, to talk about how that's playing out. But it's playing out exactly as expected. The world is starting to slow down. The US is starting to slow down. Bond yields are starting to come off. And I think even with higher prices, I know everyone thinks it's inflation. I think it was a massive tightening of monetary conditions and total demand destruction on lower middle class households. So I think that is a big problem coming. And I think bonds should fall in yield. And, right now, US bonds are a safe haven. So there's safe haven flows that come into that as well. I think generally speaking, bond yields should come down towards the 1% level. And let's see, are we building structural inflation by the changing of supply chains, or does that get solved by technology? Are factories that come from China using people that are moving to the US using robots inflationary or deflationary? Maybe it's inflationary first as you build them, and deflationary over time as the costs come down. As I said before, the digitization of anything tends to push costs down to zero over time. So I think that's going on.
If you want to listen to the full interview, click on the link provided in the description. We would love to hear your thoughts. Comment down below. If you're new to the channel, don't forget to hit the subscribe button and bell notification. Thank you for watching Daily Dose Crypto.